of discussion today is year-end tax and retirement planning. We have Mr. Chetan Dogra and we have Mr. Whipple Malik who will be talking about this. I'm going to give a brief introduction of the speakers. Before that, I'd like to quickly tell you guys about PCC. The Punjabi Chamber of Commerce is a non-profit organization that was started in 2017. It is dedicated to growing the business of our members. Anyone can become a member. You don't have to be just Punjabi. Anyone is welcome to join the chamber. The sole purpose of the chamber is to grow the businesses of the community. And we also do have other opportunities. The membership is free. We have mentorship opportunities. We connect members worldwide. We have chapters not only in US, in Canada, in Australia, in India. We're soon starting chapters in Dubai and other places. There are many benefits to join the chamber. You get to network with like-minded people, but also people who come from different disciplines of life. If you want to talk to a CPA, you can, or if you want to talk to someone who actually owns gas stations or who owns a technology company, you can talk to them. So it's a huge experience, huge benefit of becoming part of this network, and especially it's free. I have a question here. Just want to make sure. Good. There's nothing here. I'm already getting a question that are we going to be covering some Canadian taxations as well? I'll let our speakers, Ms. Chetan Dogra, talk about that in a little bit. So Harvinder will answer that question in a little bit. So let me introduce our speakers. Mr. Chetan Dogra, he is the managing member of Dogra CPA LLC. He's an experienced certified public accountant. He is licensed in the states of New York and New Jersey. He's also a certified valuation analyst. He facilitates success for businesses and individuals and structures a process to free clients from financial concerns and compliance. Prior to founding Dogra CPA LLC, he worked with PwC and other big accounting firms. He's frequently engaged in and enjoy advising clients for taxes, mergers and acquisitions, audits and appeals, and financial reporting services. Thank you very much, Chetan, for doing this for us. We really appreciate it. Our next speaker is Mr. Whipple Malik. He's the president and founder of Qbi Wealth Advisors. Mr. Malik has 25 years of experience in financial services industry and holds a chartered retirement planning counselor, CRPC designation from the College for Financial Planning. He was also awarded a retirement planning specialist title based on completion of a rigorous program from the Wharton School at University of Pennsylvania. Whipple is a graduate of Purdue University and earned an MBA from Union University, New York. He resides in Wayne, New Jersey with his wife Bhavna, his daughter Nitika, and son Yuvraj. He is an avid tennis player, a hacker on the golf course, and a proud member of PCC. So we look forward to hearing from him, and I look forward to hearing more about the golf hacking here. So awesome. And I'm going to bring it here. You know what? I'm going to stop sharing, and I'm going to invite Mr. Chetan Dogra to come and share his screen. And actually, Chetan, take it away. You control it from here, and it's your show.
I guess. Okay. Well, thank you so much, Vishal, for the introduction. I welcome you all to the webinar. I'm very excited and happy to see you guys as we are going through a very rough time because of the pandemic. Most of us have very pressing questions, that new tax regulation that has been passed to support the economy. What is the impact on us? And what opportunities are there to save some taxes? How should we treat our assets at the year end to take some tax benefits? So I have put together some thoughts some ideas that I think would be helpful to some of you, as everyone has different tax situation. So few things which I'm telling might not going to be applicable to you, but you are feel free to reach out to me, if you have more question or you want some details on anything I share. So again, I'm ready to start. So let's jump in. So a little bit about what is tax planning. Tax planning is about structuring a transaction and events in a way where we can get the maximum tax benefit. Or in other words, we can say structuring a transaction or event where we can either reduce the taxable income or we can reduce the tax rate. Now, why do we need tax planning? It's a very obvious question and everybody knows the answer. If you are successful, your number one expense is tax. Almost average successful person is paying from 35% to around 50% taxes. And then they don't have much income left for savings. So tax planning is indispensable for retirement, for your future, for your financial planning, and it is interconnected with retirement planning. So if you weren't able to save, there's nothing in future for you. Other thing, nobody likes surprises at the year end. You don't like a call when your accountant's going to call you and says, hey, you owe $200,000, and you'll be surprised, what? I have no clue. I never prepared for it. So neither I like surprises. I don't want any headache too in my life. So it's always good to plan ahead, think ahead, especially it's a very evolving process. Throughout the year, events are happening. Your filing status might change, or you have some new taxable events are adding in your life. So not only you have to see what is changing, but also you have to plan the future. Everyone these days is very conscious. They have goals and they are planning for it. So do you have to look for your financial planning also. Even though the tax side is a little bit complicated and boring, but it's indispensable. Other thing is that as things are past, moving very fast because of the political changes, or sometimes there are new economic reforms are coming. So there is always low fruit hanging there. There are some timely opportunities that you can easily grab without much effort, provided somebody gave you the information. And that's why tax planning is very, very important. Somebody is engaging for you to put together that information. Let's find out how we get tax in US. We have 7 different brackets here. And then we have another bracket here for long-term capital gains, which I will explain what is exactly is that. But looking at that brackets right now, we have 5 different filing status, from single, from married filing joint, married filing separate, head of the household, and then TE stands for trust and estates. So we have 7 tax brackets, and then the highest tax bracket, is 37%. If you look at the bottom, that's where, at certain level, everybody get taxed at 37%. Now, if you're looking at all these brackets, which one is the best filing status right now? So right now here is married filing joint is the best filing status, and the worst is estate and trust, where you start getting taxed on a very low income very quick, and then taxes keep going even though your income is not going, as you see here. Now, I want to ask you guys, how many people know or find out on the screen, what is the magic number you see here on the screen, which I will share here, that 80,000, as you can see on the other side, which is, I put it as a magic number, and I'll tell you why. As we see, there is ordinary income tax brackets I listed up where you get tax, as you're making money. I'm just considering right now married filing joint as I, believe that most of us are married, and that's what's going to be the most applicable filing status. So I will just keep the focus, for next few seconds there, so that we can understand what's going on. So long-term capital gain, and then you have ordinary income. If you have ordinary income, you see the tax brackets there, as married, filing joint, progressing. It's a progressive tax system in US. So as they are making money, they're paying more taxes. Now, during the year or in next few years, people make investments in bonds, stocks, or they have other different kind of investments. They have properties, they have businesses. So when you hold those assets for more than 1 year, they are qualified for long-term capital gains. So when you are selling those assets, like investments, properties, and businesses, after 1 year, then you can take a different tax bracket here, which is right on the bottom, long-term capital gain. So the numbers there, you see that for married filing joint, as I said, what is the magic number? The 80,000. If you're looking at that married filing joint, here is 80,000. The tax rate is 0. So now this 80,000 doesn't have to be entirely coming from the capital gain. This 80,000 is basically telling you that taxpayer income. That could be like 40,000 is ordinary income, 40,000 from capital income. But as long as total income, his taxable income is below this number, the magic number works, and he's end up paying what? Tax 0. But on what? On this income, investment income or property income. So for example, somebody got 40,000 capital gain from the stocks, and then he have 40,000 salary. So now on a 40,000 salary, he will still pay the taxes here on the bracket. But here he will pay the income that is coming from investment is 0. So this is a magic number for married filing joint. For single is 40,000. And then it is very frequently, looked into by the professionals that how they want to keep. So as income is moving forward, if you're selling a business, then you're paying is, 15% tax as your income is increasing. Now this is, again, all income inclusive, capital gain income as well as your ordinary income. Now, what is not mentioned here is net investment tax, which kicked in. As your income will go somewhere in between around 250,000, there is another 3.5% tax comes in. So it's not basically 15, as I'm getting a little bit technical here, but this thing will increase. Okay, let's move on. So that's how basically we get tax. It's very progressive system. As things were going up, we pay more taxes. Now you have to be mindful which filing status you want to pick it up. So if you have an opportunity, that is one part of the tax planning, that picking the right filing status for the client. We're going to see that in future now, right? Very quick, I'm saying future. Okay, tax planning basics. So as I just mentioned, I just put it in a now different way to show you the tax ladder. Okay, so again, I'll keep the the example right there on a status of married filing joint. As you can see, as the income is moving up, this guy is making 19,000, now he made 80,000. So first 19,000 is only paying what? 10% tax. Then he increased, he's paying another 12%. On the difference, almost like 60,000, he's gonna pay 12. So as he's gonna go up, he's more. So that's basically, as you can see, that more income is coming up, adding up, he's paying more taxes, and you can see there are almost 7 tax brackets. Now the question is, as you see the graph here, that as income is progressing, the tax is progressing. Now the question is, it is possible that you pay less tax as the income increases? And the answer is yes, but not easy. It's complicated. So I'm just going to explain a little bit on that, but it's quite possible. For that, the answer lies in the tax equation. It's the equation of taxation. Like we have equation in science, in accounting, we have equation in taxation also. And everything lies here. All tax professionals, they will focus here because every answer is here. So as long they will focus here, they can find out the answer. And that's the starting point I want to emphasize, because if you have a foundation, even though you're not practicing as a professional, but as long you have the foundation, you can ask your professional, hey, are you focusing on this side? As I'm going to explain you what is this basically. So equation says you have a taxable income. In technical language, we call it tax base, but I change it here so that you guys can digest it. So taxable income that is subject to taxes. And then you have a tax rate. So if I have a taxable income 100,000, my tax rate, let's say, is 40%, I will pay what? 40,000 tax. So in order for us to save the taxes, we have two options. Either we're going to reduce the taxable income, or we're going to reduce the tax rate. Those are the only two options. And for that, there are timing strategies for taxable income. And then there are tax rate management strategies for tax rates. Now, there's not one timing strategies. There are many, which you're going to see. And there's not one tax rate management strategy. There are many, they're very different. Now, what you have to do is, instead of focusing on every strategy, you pick and choose and craft yourself what is best for you. Even if you pick 3 and 4, you can save around good chunk, 70, 80% of your expectation. Okay, guys, let's move on. Okay, so this is about timing strategies. Very colorful though. We have 3 kind of timing strategies. Okay, we're starting right here in the current time. And we want to see what we can do when we are in the current time, or how much taxes we can save. The approach here is to minimize the tax. How are we going to minimize the tax? Well, we want to take out every deduction available where you qualify. Every tax credit incentive is available, you want to take it. And then you will do bunching strategy for itemized deductions. Why I'm saying bunching strategy, because standard deduction is now very high. So you can't itemize. Most, I think 70 to 80% people are taking standard deductions. So now if you're planning to take an itemized deduction, a technical word, like when you don't want to take a standard deduction, you have your expenses as a charitable donation, or you have mortgage interest, and you have real estate taxes, and you have state taxes. So you put them all together. But what is bunching? Bunching means pick up the year where you want to use them. So you'll pick two years of expenses and bunch them in 1 year. For example, if Biden tax law going to increase the taxes in 21, where I want to bunch all these my discretionary expenses in 20, okay, so that I can reduce the tax in 20, or I can bunch them in 21 if I see the Biden tax is going up and I'm in a very high bracket. But if I'm in low bracket and he's providing incentives, so I want to bunch where 20. So you will see, but bunching means basically take 2 years, put them together, and put them where you think is the most benefit. Moving on, bonus depreciation, which is heart and soul of saving taxes for businesses. Okay, section 170 is kind of bonus depreciation. Basically, you want to expense whatever assets you're buying, and tax code provide you to expense it. I will talk about a little bit more where it make more sense relatively, but right now I'm just giving you overview. Now, once you take all the deductions which are available, and you now see, okay, my income is very down now. Now you're ready to what? Utilize long-term capital gains, because now you are on a very low bracket and your income is low. So you're going to pay low capital gains. As I was telling you, magic number is what? 80,000. So now we want to cash out, our stocks or bonds, or, we have investment in property. You want to cash it out. Why? Because we're going to pay low tax. So if everything is working on the top, bottom is ready to go. Okay. Once we have done, save all the taxes this year, and for example, my client has a lot of money coming in, he's making good revenue, and I have done everything. I see still I'm in a higher bracket, paying high tax rate. So focus go here. What next strategy is timing is what? Now let's defer the income he's having and use the tax code. Okay, you can use retirement plans are available where you can contribute, and you can exclude the income and defer it, and you pay the taxes in future, but you're not paying now. So you're moving up. And again, there are retirement plans, there are 1031 exchange. 1031 exchange is basically you have sold a real estate and you're buying the same kind of real estate. So when you sold a real estate, you have a capital gain, and you're not interested to pay right now that capital gain tax because you're in a high bracket. So you want to move into the in the future event. So you find out within 180 days another property, and the tax code allow you to defer your capital gain in future. So kind of overview of 1031 exchange. Installment sale agreements. So you're selling something, for example, I'm selling my practice, and then I don't want to pay tax in 1 year. So I do an installment agreement that, IRS code provide you that you can pay in next future year in, pieces. 25% income I'll disclose every year. So I remain in a low tax rate. Okay, that is the whole reason behind it. Defer business revenue, that if you are on a cash basis, then, and this is December going on, do not bill your client. Even if you did their job, bill it to them in January, what you did, you defer it, you push it to the next month, next year, so that you can move the income there. But basically what you're doing is here is what? Timing the transaction, timing the event in future. Okay, so that anything you're not ready to pay here, you want to pay later. Accounting methods for taxes. When you're in business, you have cash or accrual. So if you want to push it, you can take an accrual method. Cash is what you receive, what you pay. But again, depend upon situations. The next item here is investment in opportunity zone fund. This is a bumper lottery. Not only here you are saving taxes, okay, you are deferring taxes. You can also eliminate taxes, which I will explain in next few minutes. So once we're able to defer, so we can push whatever we have right now, and we still see there's too much income he has, and we use everything, it went on the event he is in. And then we still have a lot. Then we're thinking about here. We're thinking about strategies that will do entirely what? Tax-free income. So we're thinking about, okay, can my client can be part of these events? Again, I put this opportunity fund here, top and bottom. Why? Because it can defer and it can also eliminate the tax, which I will explain right now in next few slides. Okay, so putting a money in a retirement plan like a Roth, you're not going to pay any taxes in future. Life insurances, municipal bonds, you don't need to pay taxes. There are foundations that you can set it up as a private foundation or a charitable foundation, and those are non-profit organizations. Don't pay tax. International corporations, they pay taxes over there. They can be structured in a way that either you pay very little or you don't pay any tax. And opportunity zone funds, which I will share, but it's same thing. You can invest any kind of long-term capital gain in this. In 1031, you can only invest similar kind of property, in the real estate, and that's a real estate. You're selling it and you're investing in another. Let's say you sold a hotel, you bought another hotel. But here, it can come from any investment. Could come from business, it can come from your shares, it can come from it doesn't matter. It can come from any nature. And then you can put in opportunity funds where they're buying properties or businesses, they can do anything, but that's in a certain areas, and I will explain you that what areas are dedicated to. Okay, so I just spoke about, the timing strategy, that you can save whatever currently and defer, and then if you can't defer, then you find structures where you can eliminate the tax. So now I want to tell you that, how we can take actions at different income levels, those timing actions. So as we are on a very low, here is a single status, here is a married. So as we are on a very low income status, we're making income than 80,000. Guess what? Utilize the capital gain, sell it. Because what's happening here, remember I told you the magic number is what? 80,000. As long as it is below that number, this income, you're not going to pay any tax. So then why not selling it or getting qualified dividends? Again, it is investment income, will qualify as long your bracket is down. Now, as the bracket is down, strategy is changing, right? You want to, because you're getting a higher income, which I was telling you that as a client is getting higher and higher, what do we want to do now? We want to defer some income, and we use retirement plan, and we can, do other things which I spoke before. And as it goes up and up, 32, 35, 37, guess what? We're looking for what? Tax-free events in future, so that, we don't pay it because there's too much tax for our clients, not savings are there. There's no saving for future. Okay, now this is the other part of the tax strategy. First was timing. How we are timing, events. We're timing current, future, or we time it in a way that they are free. Now, the second part of the equation was what? Tax rate. That was, the first part was dropping the taxable income, right? We drop it with deductions. We drop it by excluding and putting in a future events. And then we drop it because we excluded it by putting into tax-free structures. But the second part of the equation, if you exhausted with the first part of the equation, the taxable income, you cannot reduce the taxable income. Then what do you do? Now you want to reduce the tax rate. What is the option available here? The number one option available here is a location. Location in the real estate, as says location, location, location. While in taxation also, location plays a big role. You know, as you see that, where do you see the headquarters of the big corporations? Because US tax is very high, though they move it out, they'll put it in a place where there's no tax. Similarly, every state has a different tax. You know, then they have a city tax. So if you're in New York City, you're paying what? You're paying the state tax. Then New York City is also paying you tax. But if you're living in a border of Pennsylvania, next to the New Jersey, you might be paying 3% tax. Whereas where you're paying in a New York, you know, paying another 7, plus you're paying another 7 to the city, too much tax going on. And then you're paying a federal. So location will fix your tax rate once for all. So that's why big corporations spend a lot of time. They're moving to different locations. They'll find some of the states are tax-free. You know, some have low tax. They have sale tax, capital. There's so much in it. But again, bottom line is location is very, very important. Wherever you are living in terms of your estate taxes, you know, in terms of your sale taxes, in terms of your property taxes. This is the driver. Next thing, what is your filing status? Which I just explained you a few minutes back, that whatever is your filing status will depend. Now, if you change your filing status, you were single, paying a lot of tax, just by switching your filing status. I'm not saying just married because saving taxes, but I'm saying it's a consideration. It's a consideration for your future because you want to have a happy retirement. You're working day and night, and then end goal is that you want to save because body is like what? Body is, you know, economic asset. They know that is depreciating slowly. You need some extra income from outside, which people will explain you more on the retirement planning. But I'm just touching the basics here. Okay, guys. Entity structure. Entity structure is very, very important because, for example, as corporation, you can reduce the self-employment tax. You know, if you're not a corporation, but you are an S corporation, you're not paying a double tax that corporation pay. Corporation pay, you know, regular income tax, then, you know, then there are also people who are receiving dividend, they pay another dividend tax. So it gets double tax. So structure is very, very important. Once you find the right structure, half of the game is done, which you will find out the huge impact in next few slides. Okay, structuring a transaction as capital gain, right? So if you buy something, sell it in a 1 year, you're paying short-term capital gain, which will be treated as what? Regular income tax. But if you hold it, whether it's a property or your investment, or it is your business, then you are structuring a transaction in a way that you will pay a lower tax. This is basically for long-term capital gain. Transferring asset to a low bracket person. You know how you can transfer the asset? You know, either you can give a gift, right, to somebody. That way, if you're on a very high tax bracket, so if I'm self, let's say I'm in 37 tax bracket, and so if I'm giving, you know, some appreciated investment to my son who's in a lower bracket, then what? Somehow we save the taxes. You know, it's still within the family, but you know, just by shifting, you know, assets from higher bracket to lower bracket, it works out. Transferring income from lower bracket, from higher bracket to lower bracket. Well, same thing here, hiring children. You know, if you have too much taxes on your return, you hire a children who doesn't have income, you know, up to 10,000, you know, there's no tax. He's basically, you get a standard deduction for 12,000. So he's out, he's not paying any taxes. But just be mindful here that the tax rate is very, very important, how you play with it. Okay. What action businesses can take before the year end? So I explained a lot of thoughts, a lot of nitty gritties, you know, you can do a lot of things. But let's see here. No, isn't it amazing? Look at the Amazon here. How much tax they're paying for last 10 years? Less than 3%. Now, are they doing a lot of strategies? No. There's only focusing on 4 things here. They have the right structures in the right locations, and then they're taking bonus depreciation. Well, bonus depreciation, not because it's in the tax code you take it, the tax planning goes in hands with your financial planning. So when you're running your business, you have to think everything you're making this year where you can invest. Because if you can invest, there is no tax. You're putting everything in future. That's what Amazon has done. Never paid any taxes or paying almost nothing. Like Netflix, same story. Those guys are paying less than 10% taxes because they plan it out. The financial planning has to go with tax planning. You think ahead, and then you says, okay, if I'm receiving this much money by second quarter, what investment, what business I can buy so that I can eliminate, I can pay a lower tax. I would say not eliminate, but pay as much as low. Here, when I see this, the word eliminate comes because this is quite significant. Okay, and this is all legit because if you are increasing your assets, right, then the value of the company is going up too, and that's fine. You're putting everything for a future perspective, but to make it very short, that financial planning goes with tax planning, and then this thing is the meat of taxation. R&D tax credit. Most of the people think that this is more into research, it's more into technology. Well, a lot of industry qualifies, a lot of processes qualify, very, very complicated process to do it, but it is worth, you can get almost 6 to 20% of your R&D work, and everybody's involved in R&D. If I was making these slides for the last 1 week, what I was doing doing a lot of research, putting my thoughts together, and that is what R&D. Now, does it qualify in the code? Yes. To what extent? That we can do a research. Okay. Retirement plans. Again, 4 things here. They are into more stock options. They give shares to the employees, you give them an option to exercise. When they exercise that, they are deducting those as an expense on their books, right? So your share help you put expense on your books, and all these 4 strategies are doing this magic, and most of the corporations are doing it. Now, again, you got to have a plan, a future plan, like end of this year. If you have too much money, hey, can I buy some franchise? Can I buy some business? And you can save. I know many people, they're paying more than $1 million every year because there's no financial planning. They just come and call me and says, hey, can you help me find save taxes, save taxes? Why what? It is a reciprocity. The action has to be done from both sides. Okay, let's move on. So, here, important point here. Most of us got a PPE loan this year because of the pandemic. And the problem is what? The problem is we cannot deduct qualified expenses which we paid from PPE as a taxable expense. So now if we cannot deduct expenses from the money we received from PPE, then what? Income gonna go up, right? It's another way to raise the income. Either they say that, oh, PPE money we gave you taxable, but they twist the arm and they say, well, the money you spent, that is cannot be deducted. So then what? If somebody has 100,000 payroll, he paid 50,000 from here. He cannot deduct that 50,000 payroll, so then it has a higher income. But the worst scenario is this. I have some clients who got 0 revenue and they got more than $1 million PPE loan. Now what happened is that they paid that loan to employees. And now they're going to pay tax to that loan where there is no revenue. So if somebody made $1 million and he's going to pay 300,000 tax on it without making any revenue, that loan he took, which was paid out to employees and they never worked, the business was closed. What? He's going to end up paying 300,000. But Congress is looking into it. A lot of professionals are advising the Congress to, or IRS also, that it doesn't make sense and they are considering it. So hopefully we'll have a good news rolling in very soon. So let's go. In terms of small businesses, if you're on a daily cash basis, again, delay your income at the year end, do not bill your clients, push it, depend again, if you're a cash basis accrual, then the treatment will be different. But I'm talking just if you are a cash basis, then you delay it, push it to next year. You can accelerate, take all the expenses, you can do it, just prepay, some expenses you pay in routine, and then you can increase your expenses and reduce your income. Same, do the retirement plan contribution. Believe me, not even more than 10% people do it. And they will come with the excuse, I don't have money. And then they pay and they'll pay taxes. But the money you're putting in a retirement plan, it can come from your taxes, because a retirement plan does 4 big benefits. It defers your income, okay? It saves you on a payroll tax. It shifts your tax bracket. It reduces certain phased out deduction. So some of the deduction as your income goes up, what happened? They get phased out. Regulation phase them out. Well, by reducing income, by contributing into retirement plan, what you can do? You can get back into that income level that where your reductions are not phasing out. So look at the magic. 4 things are happening. Okay, and that's a number thing here. You can see it here in the retirement plan, there are 401k and stock options. So this is, now thing here is, client doesn't know much about it. And then again, on the professional side also, everybody's running into just filing it. Nobody's planning it. But this can basically pay your taxes. Okay. More on this, you can call Whipple and understand, because this is key, guys, key. Again, as I told you, bonus depreciation is meat for the business. It's a butter or meat, you can call it. 100% bonus depreciation. Okay, you can buy assets except, the property. I mean, any renovation you're doing inside the property, that will qualify, whether you are, putting a HVAC system, air conditioner in it. You get 100% bonus depreciation, interior renovation, as well as you're buying any asset, machinery, equipment, furniture. Most of things will qualify. Okay, and now the beauty is what? Beauty is that if you are doing a regular depreciation, like depreciation means that you're going to expense in next 5 years, right? You need to prorate every quarter, based on the formulas that, if you buy an asset in February, then up from February to December, you're going to take a depreciation. But in a bonus depreciation treatment, that regulation, even you bought the asset 5 days before the year end, you don't have to prorate throughout the year, number one. And then you can depreciate the entire asset as long it put into service on December 31st. Okay. Similarly, there's a section 179, mostly works like a bonus depreciation with the very minute differences are there. But it has an expensing limit that you can take only $1,040,000 expenses under section 179, but your total investment, when you are doing all the investment in these capital assets, has not to be more than 2.5 million 90,000 here. Again, I emphasize that R&D credit, same thing, 6 to 20% you can save on qualified expenses you did, and you should review your accounting method, which I spoke before. Another thing for small businesses is Qbi deduction. So most of the pass-through entities can get 20,000 straight deduction as long their income falls below this magic number, 326,600. This threshold is for married filing jointly. So everything I'm talking right now is married filing jointly. Okay, just gonna say a few words quick on the QBI again. The threshold amount again, this is the magic number, 326. You wanna make sure the number is your total income. All the income, taxable income is below this number. As long then any income you made from your business, whether you're self-employed or you are having a LLC corporation, you'll get that 20% chunk. Okay. Now there are some conditions there. The deductions start phasing out. Okay, depend upon your service and the trade you are in, depend upon your payroll level, and then depend upon the basis you have in qualified property, basically how much properties you have, investments are there in your assets. Retirement plan contributions. Again, I'm not going to go into here again. I told you as there are 4 tax benefits, that you're deferring the taxes, you are saving on payroll, you are reduce the impact of certain phased out of deductions, shifting the bracket as we spoke. Now question here is, what can I put it in? As a employee, that you can put 90,000, your employee contribution, 90,500. If you're over 50, you can put another 6,500, right? So overall limit is what? 57,000, you can do it. 50,000, 7,000 mean that as employee and employer contribution together. So if you are a small business owner, this much money you can put it in, but provided the math works, you have enough wages, so that limit comes around 25% of your wage. If that numbers fall, you can take, let's say you have 200,000 salary. So if you're taking a 25% of that, and then you're looking at what number is it coming? If that number is above that number, then you can do only this much. But if that number is below this number, then you will take that number. But your limit is only 57. Okay, IRA, if you don't have any retirement plan from your employer, you can chip in yourself. You get until April 15th to put this money in. So you can put any time, before the tax filing season. Again, 6,000 catch up is, again, if you are over 50, you can put another $1,000 there. Simple IRAs, again, there's like a 401k, there's another retirement plan that, you can contribute 13,500, catch up again, 3,000. You can speak to any guy who's providing a retirement plan, but guys, please, please, please understand this. This has enormous benefit. There are so many guys in PCC, our chamber, that does retirement planning, and they provide you, investments in retirement plan. The only problem is, there is no proper education, or the thought doesn't get across. Okay, quick thought here on, individuals. Standard deduction, as you see that, boom, 24,800. So most of us will not qualify for itemized deductions. Nothing has changed, just a small tweak for inflation changes, but the all deductions are same as last year, where you cannot take more than 10,000 in state and local taxes, right? So Medicare, in order for you to expense, the expense has to be over 77.5% of your AGI. But the whole thing here is that what is the solution? Almost the tax code has eliminated, unless you have a lot of big charitable contribution, right? And most of people don't make charitable contribution because they're not getting any benefit. So they're saying, I'm losing all. I'd rather pay lower tax and keep the money in my pocket. But then there are some people who are generous, they want to pay back to society. So there are some strategies there, which is basically out of the scope of this webinar. But definitely, if you guys have questions, we can go over, or people can share that on that. So what strategy can be used? As you remember that I spoke a little bit about bunching. Bunching what? Take the deductions you have, pick the year, take 1 or 2 years and bunch them together and then put them together. So for example, you have, your charitable contributions, you think you're gonna have medical expenses. You pick up the year and take all discretionary, because certain things are beyond your control, like taxes. You can't push it, right? So you can think about it if it makes sense, provided there is, a big amount that is coming in, and then you can still use it. So what is the new rule? The new rule is bunch deductions together. What was the old rule? Old rule was accelerated deduction. Increase as many deduction, but what? Raise the bar so big. Makes no sense anymore. Okay. Now, once you take all the deductions, what do you want to do now? Then there is another thing called credits. Okay, you want to then emphasize on credit, but credit has a problem. What is the problem? It's meant for who? Low income people. So the moment you start making money, what's happening? They're phasing out. So they look very good. Numbers are very good. When they do all the announcement during election, we're going to give you 4,000, child credit, or 8,000. Well, basically that benefit is for, low income families. Let's go over quick. Child tax credit is $2,000. Dependent credit is there, $3,000. Maximum you can take is what, 6,000. If you have two or more than two kids. Education credits, there are two different kind. One is American Opportunity Tax Credit, where you can take $2,500 credit. Again, everything subject to your income. If the income is phasing out, you're in a low level or high income level, and then these deductions, all these credits are phasing out. So you can use the retirement plans to decrease your income, so that now what's happening here, as I spoke you, the retirement plan will qualify you for credit as well as deduction there. So the cumulative effect is big. Okay, earned income credit, again for low income families, they can take 6,000. Savers credit, people who are very low income, but they want to add money into their retirement plan, they get $1,000. Okay, this is again very, very important area, long-term capital gain strategies. Okay, harvesting capital losses, harvesting capital gains. Now, harvesting capital losses basically, hey, when you want to time the loss, when you want to use it, and when let's say you have a capital gain and you take a capital loss and then you wash it out each other, you reduce your capital gain. So that's basically, that is called harvesting capital losses. But you need to be aware of these two things. One is wash sale rules. So if you're selling a long-term loss asset, you cannot buy it within 30 days. If you buy it, you can't take that loss. And then what is this magic number? 80,000. Now, if you take a loss, okay, your income is already below what? 80,000. So below 80,000, there is no capital gain. So the loss is waste. So you want to be, cognizant that I want to use that number when my capital gains are higher. My income is more than 80,000. That time you want to harvest. So bottom line is what? Harvest when this number get crossed on your income level. When the income is going over 80,000, that time you start opening the toolbox for harvesting capital losses. Okay, and you can use it against capital gain. Harvesting capital gain, again, 80,000, zero, but doesn't matter, as you can see the bracket here, as long you're not crossing the bar. I think there's number missing here is 250,000, because after that there's net investment tax kicks in 3.5%. But I would say if you are below 250, that's not bad, 15% compared to the other taxes you're paying it. Now, step up basis. Step up basis is that, let's say you sold something, you got a capital gain. Okay, you right away, this is one of the favorite strategy I have, like you right away invest it again. Okay, you investment the same, because in a capital loss option, you cannot buy it back in 30 days, but if you have a gain, you can buy it right away. So if you buy it, let's say you are under 80,000, you took your capital gains, you paid zero tax, next day you go buy it again. Because what's happening here, you did not pay any tax on the basis of your stock, right? And now your basis go up, boom, now you buy it again. So you keep buying it again, the basis keep going up, provided the stock is going up. So if you're confident the stock will go up, then step up your basis. Okay, now, good thing is, you can bunch 3 strategies together. Okay, let's looking at a case study here. Mrs. and Mr. Sam got 50,000 ordinary income. They got 50,000 long-term capital gain, and they got total income is what? 100,000. Once they get into 100,000, under 80,000, there is no capital gain. Now they're going to get next 20,000. They'll pay what? 15% only on the long-term capital gain income. Now, can they do it zero? Yes. What they have to do? Harvest the loss. If there is any unrealized loss sitting in their scenario, they have $20,000 unrealized loss sitting there. They'll take that loss, they'll sell those investments. They got $20,000 long-term loss, and they will use it against what? The capital gain. So then, if they take that 20,000 from 100,000, they came to what? The magic number. And the magic number help by bunching these strategies together. They come back to zero, and they took their money also, and then they buy it back again. Let's bump it up the basis, and you keep playing that game. Okay, do a 1031 exchange, long-term capital gain, again, deferring a long-term capital gain. If in a similar property asset, you sold a property within 180 days, you bought similar kind of property, which has, certain conditions, then you keep deferring, as long you're waiting for that when can be the right moment where I can pay either the regulation change or your income goes so down that you can use the capital gain against your other incomes, and you pay less taxes. Okay, uh, gift appreciated asset to family members. Okay, so if you're you're right here in 20%, and just by moving your asset from you to your family member, there is exclusion available, as Vipulji explained. I keep coming back to Vipulji because he will tell you more on this, retirement planning strategies or estate planning. So each person can pay 15,000. A family member, the husband, wife can do 30,000. So they not only cash, they can just pick it up, that investment in stock, and then they can move it from this 20% to where? 0. Okay, so think about, moving the asset from you to somebody else where it makes more sense.
Chetan, a question came up. May I ask a question at this time?
Yes, go ahead.
So a question came up about, let me pull it up, from Ankit. Does the QBI of 326,000 limit include the amount contributed to the 401k? So the money contributed to 401k.
Well, yeah, so it depends. If it is like deferred, then you can use a 401k to take that deduction because you were excluding your income. So let's say you qualify for 57,000. So you can bring it down by 57,000, your income, and then you stay in that limit. So again, retirement plan can be used to be in the limit. Anything you have, you can do it. Now, if it is a Roth IRA, then what? There is no exclusion because you're paying tax on it. Doesn't make any sense. So it will depend upon the circumstances and fact. But yes, to answer the question, yes, possible.
Couple of other things. So before you get into NIIT, I know you are going into there. Uh, some interest has come in on CARES Act. I know you were going to cover it today, but given the timing, we're at 7 o'clock mark. Do you want to cover that? Like a couple of people have asked for that. So can we cover that in a separate webinar or something like that?
We can do that as well. I think we're almost there. I'll just give a quick 2 minutes overview of that also.
All right, we need to.
Okay. Or we can do another webinar.
Right. So we'll have Whipple start at 7:10, so you can see what you can cover until.
Okay.
Okay.
Well, thank you for the consideration. I'll try to spin the wheel as fast as I can. Okay. So 3.8% net investment tax. As here's the magic number, 250,000. As your earnings, investment income, all incomes are going above this number, and you have income from investments, then you will have to pay tax on the investment. So example is right here, 240,000 income coming from the earnings, and then they have a dividend of 20,000. Total income is 260. So now since they pass this threshold, now they have to pay tax on the investment income, which is what? Over the threshold. So this 260 is 10,000 over the threshold. Only you paying tax on the investment income, anything that passing the threshold. Okay, guys, opportunity. This is very, very important, but I spoke before it. You can defer taxes, you can eliminate taxes. Okay, and the way it works is that you have to buy within 180 days of your investment. You can, if you hold the investment for 5 years, your basis increase by 10%, then another 15% on 7 year, 10 year, you're almost paying no gain. So you took a capital gain from anywhere and you dump it here, and provided you got the right investment, then you end up paying no tax after 10 years. So elimination, timing strategy. CARES Act is right here now. Okay, the CARES Act was passed here with some tax changes that can help to speed recovery of businesses and individuals. And I will go very quick here. Everyone receive a $1,200 check. People who are under a certain age limit, and then they don't have to pay that money back tax free. Number one. Second thing, the people who never got qualified for that amount because their income phased out, they can check when they're filing 2020, they may qualify because people got it for 18 or 19 basis. So they might get qualified in 20. Okay, so if they get qualified and they received less, they can take a partial or they take a more money. But if they don't qualify in 20, you don't have to pay it back, free money. Cashing out retirement plan, from the retirement plans, CARES Act provided you that you can take it out up to 100,000 from your retirement plan, uh, provided you are either sick by COVID or you have a financial hardship going up and there are certain other conditions, and then you can take that money out. You can, uh, when you're taking that money out from retirement plan, you're gonna have a taxable event. So if you have a taxable event, you can pay taxes in 3 years, okay? Or you can contribute that money back into the retirement plan within 3 years, and then you can file a refund for whatever taxes you paid. Doubling retirement plan loan options. So before you can take 50,000 loan option, now you can take what? 100,000 loan. But also they're giving you extra 1 year to pay it back. Okay, it doesn't have to be like with the related to certain conditions where you have here in cashing out that it has to COVID and financial hardship, and you can qualify here. Waiver of required minimum distribution. So when people hit the age of 70 and a half, they have to take that money. Secure Act has increased that age from 70 to 72. So you don't have to, and also CARES Act doesn't ask you to take withdrawal this year, so you can put it off. There are a lot of other strategies there under, but since we are short at time, so I'll go very fast. $300, very immaterial amount. There's so much noise on it, but there's no tax benefit of it. $300, if you, in addition to your standard deduction, you can take it. I mean, small pennies are here. Okay, guys, so let's go. Let's go here on the business side. What CARES Act has provided you. You have, if you did not take a PPE loan, you are still holding your employees. You can get up to 10,000 credit for each employee. That credit has to be taken on a quarterly basis, but maximum is this. They say 50%. They'll 50% of the wage will qualify, but maximum is this. Payroll tax deferral, 6.2%. The employer pays, you can defer it for 2 years. Okay, that basically you pay half of the payroll tax in 21 and then half in 22. Okay, and then you don't have to pay the employer part. And you can also not pay the employee piece, but I won't suggest for that because we don't know if the employee has not paid it, then who's going to pay it later on. The code is not clear there. Okay, carry back operating losses. You can take the losses retroactively from 18 to 20. You can push them back for last 5 years. And you can, file amended returns. If you have a corporation, you have an operating loss in this year, you can push it back in last 5 years. The code doesn't allow you anymore to push back, only carry forward. But now under CARES Act, there's an option, and you can amend the return and take some benefits. Similarly, under code for small businesses, they have a limited, a limit up to 500,000 of loss. They can take it against the other income. That limit is also removed. So if you have a loss coming from your small business, you can go up to any extent to take it. Business interest expense. Again, this is for income if you have over 26 million. So most of people not here, I guess, have it. Then, whatever expense you have, interest you have, you can take only up to 50. Before it was under Job Act 30%. You can qualify. But if your income, your revenue is below 26 million, the whole interest you can take it. Qualified property, again, you can get bonus depreciation. Before it used to be depreciate under 15 years, but now you can take it, for the like quick right this year for any improvements you did. Even you did a leasehold improvements, you can still take it. Okay, guys, so that's pretty much a quick overview of that's quick here. Another 30 seconds on the Biden plan. I will put it there. That's where the new government is coming in, and they will have on agenda that they are planning to increase the corporate tax rate from 28% or 21% to 28%. Certain brackets will gonna go up, and then they will waive off the long-term capital gain as your income is going $1 million. And then there are certain other things are there that this is important thing here. Right now you have exemption, making gift to a person of your under gift tax, you can just move your asset up to 11.58 millions to another person without paying any taxes. That limit might going to reduce for a joint filer, maybe 7 million. So if you have a lot of assets you're planning to, gift, then this is the year to do it, or do it quick as soon as possible. Similarly, he's trying to do other things on the QBI side, which I'll discuss later on sometime. So I guess everything is over here. We are almost there. Last thoughts, very, very important. Do not be very aggressive with the tax planning. If you're very aggressive with tax planning, you're trying to become an Amazon, so that that can put you in trouble, because Amazon has a lot of investment coming from outside. People are so publicly traded, they can use public money. So you need to be bankable. So if you have no taxable income, nobody's giving you money. So you can't run your business. Business can be killed by cash or by compliance. Valuation will go down of your business in the next 3-5 years. If you're not paying any taxes, you plan to sell the business, you can't recover anything. Okay, potential candidate for tax audit. If the IRS has system set up, sophisticated system, they benchmark everything. You're going down in those benchmark, you're getting a letter. Okay, won't able to sponsor your employees or provide financial support to other people, in terms of visas. And most important, you're not paying anything, you're not contributing anything. In terms of Amazon, when we say, well, they're contributing huge, they're employing a lot of people, and they're major investment. Similarly, they are doing a contribution in a different manner. So again, but if you're not doing any investment, not employing anybody, then you're not, and not paying any taxes, I guess then that's a bad situation. So over to Vipulji now. Everyone has a different tax situation, so make sure you talk to a tax professional before you take any thoughts on whatever information I shared. Thank you so much for attending the webinar.
Thank you, Chetan. Thank you so very much. It was really, really informative. We definitely have to bring you back for a follow-up, because this is so much information.
Perfect.
We need some more bite-sized sessions with you to go over that.
Yes, guys.
Thank you. Vipulji, it's all you now. Please take it away.
Thank you, Vishal. Thank you, Chetanji. Wonderful event. I'm glad. Thank you, PCC, for putting this together, and thank you to the attendees for being so patient on a Friday evening. I know we're cutting into a lot of Punjabi drinking time at this hour, but I want to keep it short and sweet, and sort of just focus on a couple of the key issues that we feel are important, especially with the year that we have all gone through. And what we really want to see is how we can maximize from here, and how we can sort of build and continue to prosper despite the adversity that we find ourselves in. So I think Chetan set it up very correctly, that you don't want to have the IRS be one of your partners in your business. And continuing in the same vein, what we always talk about is how you can create strategies to disinherit the IRS. Don't let Uncle Sam be a family member. He's not your uncle. You don't need to invite Uncle Sam to the Thanksgiving table, to the Christmas table, to the Diwali function, to the birthday parties. That's not what Uncle Sam's focus is, right? We need to make sure that we are able to protect, preserve, and grow our assets, so which will provide us and our families the ability to have a long, prosperous, healthy life, at the same time paying our fair share of taxes. So we are all for, as Chetan pointed out, we want to contribute to society. I think as a community, we find that we are extremely focused on doing that. We believe in doing the right thing, especially the Punjabi community, the Sikh community. We're all always doing the right thing by that. But at the same time, we don't want to be, working for Uncle Sam at the end of the day. So we'll talk a little bit about that, and really talk about how, from a retirement standpoint, what it is that we need to be focused on. So I'll just share a couple of the quick slides. Vishal, I hope everybody can see these. If there's any issue, just let me know.
All good.
What are the things that we can control, right? So just wanted to talk about what areas we have control over, what areas we have some control over, and which areas are out of our control. So when we talk about the retirement equation, What is it that we have total control over? Saving versus spending. I think Chetanji pointed out the right thing. If you don't, if you don't position your business and move the assets from one pocket to the other, you end up paying those in taxes. Once those taxes are paid, those assets are never recovered, right? If you can shift those assets and that income from one pocket to your other pocket, now you are actually saving that for future use. The second thing he touched about, asset allocation versus asset location. He correctly pointed out how asset location is becoming important. We don't have to be an Amazon, we don't have to be an Apple, we don't have to move our offices to Ireland or to the Cayman Islands or to any of the so-called tax havens. All we have to be smart about is talking about asset location on the balance sheet. Asset allocation, most people are sort of familiar with how much should one invest in stocks, bonds, cash, alternative assets, real estate. That's asset allocation. Asset location talks really focused upon what are the various buckets of assets, tax deferred, tax free, and tax advantaged. That is asset location. So the idea is you want to have a mix of asset location and asset allocation. Both these things are totally under our control. So we have complete control over that. What do we have some control about? Employment earnings and duration, how long we work, what is our total earning capacity, how do we maximize that? We have some control over that. Longevity, typically longevity will depend upon how long we are able to maintain our good health and what are our sort of our genetic maybe sequences, how we maintain good health, how long we're able to work, how long we hope to expect to live. So those we have some control, obviously, God willing, we have some control over that. Things that are out of our control are things like market return and policy regarding taxation, savings, and benefits. So rather than focusing on things that are outside of our control, I think if we focus on what is under our control, we can put together a good plan. Switching gears, let's sort of look at what exactly is retirement planning. I mean, people think of it as, you know, as use it or lose it sort of a thing, but it's more like a marathon, right? What are we going through when we are planning for retirement? Savings, 401k, finance. We talk about the sandwich generation, taking care of parents as well as children at the same time, college loans and college funding for kids, healthcare costs, social security, and then the final goalpost is retirement. So the idea is the sooner we are able to sort of put together a game plan and chart that plan and then sort of follow up on it annually, quarterly, semi-annually, whatever that frequency is, the better we are able to reach to that goalpost. What's happening from a demographic standpoint? Okay, the good news is we're all living longer. The bad news is we're all living longer. Okay, God willing, if we are able to maintain our health and live a long, healthy life, which means we'll need far more money in retirement than our parents or our grandparents needed, right? So as life expectancies, especially in the West, in the US, in Europe, Japan, of course, is an outlier. I think the oldest person in the world is now in Japan. He's past 110 years old. I also believe we have, in fact, a PCC member whose grandmother just crossed 103 living in India. God bless her. So the point is, as we live longer, the probability of living up to a certain age for a married couple increases substantially. And as you can see, for one person, if a married couple age 65, the probability of one of them at least living to age 90 or 95 or even 100 is, 10, 20, 30%. So which means a lot of more assets, more planning has to go in when we're talking about issues in terms of providing for that longer lifespan. Some of the issues that we talked about, how much will we need in healthcare? What is the impact of inflation, right? So think about this. When we were used to go to watch movies in 1990, of course, there are no movie theaters open now, and we're all on Netflix, which is great, but the price of a movie ticket is now close to 10, 12, I think in prime Friday, Saturday evenings, it's close to $14, $15 at the theaters, right? A Starbucks coffee starts at probably at $4 and goes all the way to $8 or $9 per coffee, right? So the point is, inflation is a factor, and that is something that we all have to plan and prepare for. And we'll talk about how the certain asset classes which will depend upon keeping us ahead of inflation. What are the chances that you'll work in retirement? A lot of people feel that they will continue to work, which is a great thing. If they're able to do so, that's great. But that's a hope, that's not a plan, that's not a strategy, right? So if you're able to continue to work well into our 70s and 80s, God bless us. But we should not hope for that. We should already plan for that either way, because the reality is that smaller percentage of people will work in retirement as they might think, right? We talked about inflation. It has been tame in recent years, but still it is very painful on areas which I think are most important. Things like healthcare, hospital services, things like college tuition and fees, right? Things like medical care services, housing. So the areas in which really make an impact, inflation has gone up a lot, even though, typically inflation is considered at 2%, 3% range, which is the norm for the US. Again, another slide about understanding our expenses in retirement, realizing that the 30% of retirees currently say that their expenses are higher than expected, right? And especially because, now that once we have the vaccine, I think we all want to get back to travel. And especially if somebody who's retired, the whole idea becomes that they want to have the time now to travel. So we have to plan for that and, prepare for all those issues. Healthcare obviously is the biggest expense that we can all expect to have going forward. So here's a quick slide, which will, I think, eye opener in terms of how dramatic the healthcare cost projections are for a couple who's in their 60s as they expect to live for the next 20, 30 years going forward, right? And it shows at every age, these are just the annual healthcare cost projections on an annualized basis. So these numbers ramp up pretty quickly, as you can see. And again, the idea here is not to go into the what and the how we need to do this, or the what or the how to do this. Right now, I think if in this meeting we're able to convey why retirement planning, why planning for the future is important, I think that really is the starting point. So all the tools are available, all the strategies, the solutions are available. The important thing is for people to understand what it is that they need to do going forward, right? Again, quick slide. I know we have a couple of doctors, who are in attending. My shout out to Dr. Malik, wonderful young physician who's been at the forefront of the fight against COVID, and we are so proud of him. God bless him, and we hope that he's doing well. So the idea is, as we have access to medical professionals, medical health, the whole point is not just how long will I live, but how long will I be healthy? And as we can see, the percentages of things like heart disease, Alzheimer's, diabetes, cancers, all of these things can add up and sort of require a much bigger sort of a planning horizon, so that we can address some of these issues going forward, right? And again, this talks about how healthcare costs have been rising, and what are some of the new strategies to deliver lower cost care. I know, Vishal, you're a savvy investor and follow the markets. I'm sure you know what the companies like Teladoc and Livongo Health, how they have exceedingly done well over the last 9 months, because we're all seeing a move towards digital health, which is great in terms of service provider, but also needs to be sort of factored in going forward. So this
That's
is
true.
one example of, I'm sorry, was there a question?
No, no, no. I was saying that's so true. Healthcare costs are going up so high, so fast.
Yeah.
We need to all plan for that.
Absolutely. So this is one example of a account, like, which is, some of you may be familiar with that, HSA or healthcare savings accounts, which basically allows individuals to pay for out-of-pocket medical expenses using pre-tax dollars, right? So again, one example out of many which can be utilized. The point is, how do we create a strategy, as Chetan correctly pointed out, whether it is bunching, whether it is timing, whether it is lowering the taxable bracket, lowering the tax rate. How do we sort of utilize a lot of these combinations along with things like 401ks, 403bs, tax deferred plans, tax advantage plans, tax free plans. So the key is, there is a saying out there that, the US tax system, or the IRS tax system, is a purely voluntary one. Tax avoidance is perfectly legal, tax evasion is illegal, right? So what we are talking about is simply smart tax planning, not everything doing it by the book and doing everything within the confines of the IRS tax code, okay? Again, some stats on HSAs that we can sort of skip over. What are some of the other issues that I think which are important, which oftentimes are ignored? This is another area which I think, especially in our community, as the community ages, becomes increasingly important, is things about long-term care. I think a lot of folks, I have gone through that personally. My wife's family is currently going through a situation like that with her mother. So I can speak both from personal experience as well as from client experience about how important it is to plan for these long-term care needs, which, as we said, as a sandwich generation, we're, especially within the Indian diaspora, within the South Asian, the Punjabi community, we are all very family-driven, family-oriented. We take care of our elders, but at the same time, we can do that smartly. We can do that in a tax-efficient manner. We can do that in a way which will not create stress, economic or personal stress, upon us when that moment arrives. So I think it goes without saying that there is definitely a need to look at some of these issues, and we have some very, very robust solutions to provide care for long-term care solutions as well. Social Security, as we all know, during our working years, we all contribute into Social Security. Now the question becomes, when will we start taking it out? What is the best age at which to withdraw it? How can we maximize benefits, right? So here is a quick sort of a chart which talks about how Social Security can provide income replacement at different income levels, right? So let's look at somebody who's in a high, using that magic number that Chetan referred to, the 80,000 cutoff income level. Let's call that the level of 82,000 in change. Social Security now will replace 33% of that earned income at somebody who retires at age 65, okay? Somebody who's at the Social Security wage-based maximum taxable limit, which is 127,000, because Social Security phases out at higher income limits. Somebody who's phasing out at that can expect, as a percentage, only at 26%. Obviously, in absolute dollars, it goes from 26,000 to 32,000, but then as a percentage, it drops, right? So what it really means is that most folks who are in this bracket need to then plan for the remaining 74% or the remaining 67% that is not going to be covered by Social Security, right? And that onus is upon the individual. That will become the responsibility of the individual to plan for this gap, which is not going to be covered under Social Security. And I think that's very important for folks to realize, because we don't often think about it as an income replacement issue, right? What's the magic number? What's the magic number to unlocking Social Security benefits? It depends upon really the age of birth, right? So anybody who is born from 43 to 54, their full retirement age is at 66. Anybody from, in the 50s all the way up to 1959, their full retirement age is at 66. But anyone born after 1960, their full retirement age is at 67. So that's very important to know, because in order to maximize the Social Security benefit, one should realize that you need to be at full retirement age, because if you start withdrawing too early, which is called early retirement, then you take a haircut on the Social Security benefits. So I think that is a very, very key part to understand. And again, this again talks about how people can do it if they delay what is called early retirement, full retirement, and then delayed retirement. They can maximize their benefit up to 132%, as opposed to taking a haircut of 75%. So the numbers can ramp up the later that you take the more you defer, but which means that if somebody is retiring at 66 and delays taking Social Security until age 70, then should have enough other assets to provide for it themselves over that period of time, right? So moving along, again, this again shows that if you're claiming early, you're leaving money on the table. If you're claiming at your full retirement age, you're getting 100% of the benefit. And the longer you're able to delay it, age 67, 68, 69, 70, you can see how the benefit goes up by 8% every single year. So the idea is the more you're able to delay that, the more you can increase that benefit, which is ultimately what the objective of a good planning for exercise is. How much is enough? Again, there is a lot of research out there. There's a lot of numbers out there, but I'll just give you a quick quote on some of the a survey that was done this year in 2020. And this is again done by a number of independent organizations, asking how much money do people need to have to feel rich or wealthy, right? Again, definition of rich or wealthy is it all depends, right? Current depends upon a number of factors. But in January of this year, in 2020, the participants who took the survey felt they needed at least 2.6 million to feel rich, okay? $2.6 million of net worth to feel rich. But they only needed about 935,000 to feel financially comfortable. So as you can see, there is a gap between 2.6 million versus 934,000 between financially comfortable to feeling rich. And obviously, every person has to define that number for themselves. But the point is that for somebody who is making whatever that salary is currently, this is a way for them to calculate what their monthly replacement income needs to be and what their total account balance needs to be. So it really shows that somebody making 150,000 needs to have a total account balance of 1.8 million to create that income, which will substitute for their earned income when they retire, right? So you can do that for each age group and each salary level and come up with the calculator. Again, this is not the forum to do that, but the point is we have the calculators, we have the ability to drill down and come up with the exact number based upon the client's profile. Okay. Again, think a quick slide about compounding. The importance of an early start, somebody who starts at age 25 versus somebody who starts at age 45 or age 55 has to contribute much more and still can never make up for that compounding, because that is really the name of the game. I think it was Einstein who said, compounding is the biggest, the biggest asset in the world, because he understood what the power of compounding is, right? So it just shows start early and stick to it, as opposed to not waiting for it. again, tax rates lower in retirement, same in retirement. It all depends upon what makes sense, whether it's a Roth or a traditional. Again, this is more individual, so we can, maybe touch on this at another time. Roth versus pre-tax contributions, how those make a factor. Effect of loans. I think Chetan touched on it, that under the CARES Act now, with the COVID crisis, we have the ability to take some loans which are double the amount. So typical amount from a retirement plan was 50,000. This year it's been doubled to 100,000. The point is that should be the last resort. That truly should be the last resort of liquidity, because anytime you take a loan out, that money is therefore can have a long-term impact if you don't put that money back within a certain period of time. So the fact is it's available, but really one should avoid taking it as far as possible, because it can have a dramatic effect on long-term savings. Right? And then some of the challenges that women face about that as well. So it's ultimately, I think that's really the, and I can touch on the fact that women will have higher expenses, healthcare related expenses. So the idea is that that's why we recommend that family members plan together and create a plan by talking about it, by acting on it, and by monitoring it going forward. And here are some statistics which are truly alarming, and which are basically for the entire population. I think the South Asian community, the Indian community, typically does better, but I think there's a lot of room for improvement. But the overall statistics are 50% of Americans do not save regularly for retirement. 48% of Americans do not have enough emergency savings. 54% do not own any life insurance. 74% do not have an up-to-date will. Okay. Even among the wealthiest families, 90% of wealthy parents have not provided a full financial picture for their child's future inheritance. So a lot of these issues, even among the most wealthy families, the top 90%, the top 70%, have really not planned by doing what we call true legacy planning. And true legacy planning is what is important, because Andrew Carnegie said it best. He said, wealth can be created and destroyed within 3 generations. And he called it shirt sleeves to shirt sleeves in 3 generations. So the key message here is that as we grow our wealth, as we do well in terms of accumulation, it is equally important to protect and preserve those assets, to make sure that the wealth truly transcends across generations and creates a platform which will then continue to grow, not across just 1, 2, 3 generations, but perhaps 5, 6, 7 generations. That's how true wealth is created in America. And I think that's where the opportunity lies for all of us in the community. So with that, I'd close it and open up to any questions as needed.
Thank you, Vipulji. Thank you very much. It was very, very informative once again. Aman, do you want to take any questions that are on the chat or Q&A and take it from here?
Sure thing. Let me see. So I believe this question is for Chetanji. So Ankit is asking one other question: can short-term gains be used for opportunity zones? I think you're on mute.
Okay, I'm sorry. Yes, the answer is yes. Either short-term or long-term, both can be used. That's based on my understanding. Can you hear me?
Yeah, sorry,
Yep, yep.
I was on mute.
We heard you. Thanks.
Thank you. I'm scrolling through. I'm not sure if I don't think I missed any questions on there.
There's a question, I believe, on the chat, which Ankit asked, Dr. Ankit Malik. Let me see. Yep, he just posted it again.
Oh, yeah. So the question is, can you discuss the new NJ bait for pass-through entities?
Yes, NJ bait is enacted, I think, for any pass-through entity, I think starting from January 2020, they can elect to pay income taxes at the pass-through level rather than paying at personal level. And the tax is somewhere around, it's on a bracket from 250,000, you're paying around 5%. And as the income goes to 5 million, you'll pay 10%. So 5 to 10% tax you will pay on the pass-through entities, and they will give you a credit that you can use it at your personal tax return if you do not qualify for taking itemized deduction. I guess I answered the question.
Great. Thank you very much. Checking the Q&A section here. Doesn't look like it. I think we've covered all questions.
Yep.
So
We can open it to other questions. Any of the attendees have any questions? Can you please post it now? And I didn't do a proper introduction for Aman, sorry. So Aman is a young and aspiring attorney in our Punjabi Chamber New York group. And he's part of the New York committee. He helped put this together. So thank you, Aman, along with the whole team, Gary, Virginia, and other people in the team. So I want to thank everyone. But Aman, why don't you, if other questions come in, good. Otherwise, if you can tell us more about yourself and how you got involved with PCC.
Sure. So if any other questions do come through, I'll keep an eye out for that. But thank you for the introduction. Thank you, Vishal. So I actually joined PCC earlier this year. At the beginning of the year, it's been a long year, but the beginning of the year, Gary G introduced me to the team, and it's been a truly amazing experience so far, especially in uncertain times as this year is presented. PCC has still been a beacon and a resource for up-to-date knowledge and information, remote networking, and professional guidance. It's truly a great resource. As Vishal earlier detailed, the global initiative and mission of PCC and the commitment of its members to come together as a community is truly extraordinary to help each other and advance. It's extraordinary, it's unique, and it goes across every single discipline, every industry, whatever you can imagine. So I strongly encourage everybody looking to grow personally and professionally while also giving back to join. I think it's www.punjabichamber.com. Join, engage with the community. It's a growing community, and encourage others to join. So I don't know if I don't think there are any other questions that have popped up. But with that, I'd like to thank Mr. Mallick and Mr. Dogra for gracing us with such an amazing conversation. Very informative, very delightful. I think I speak for everybody when I say thank you for providing us a thorough understanding of why diligent and timely tax and retirement planning is of utmost importance. And we look forward to a follow-up for the CARES Act. So hopefully we'll schedule that soon. And with that, I guess I will wrap that up. So thank you once again to the wonderful panelists and everybody who joined. And I hope you have a great rest of the evening and great holidays. Good night from New York.
Thank you so much for the opportunity. It's my honor to be here.
Thank you.
You guys have a great weekend and enjoy holiday season. Thank you.
Useful. Thank you.
Yeah. Thank you, everybody. Happy holidays.
Thank you.
Happy holidays,
Thank you, everyone. Thank you, Vipulji. Thank you, Chetan. Thanks a lot, Aman.
guys. Thanks.
Thank you, Sandeep, as well. He's unmuted. Thanks.
Bye-bye.